Hi, everybody, and welcome back to video number 4 in chapter 12. And when we left off, were looking at how we should record um, gift cards when they are issued and redeemed. And in this case, to record the sale of the first 10 gift cards, we're going to reflect the fact that we've received $2,000 in cash. But also, we will create the unearned revenue liability for $2,000. Then in April, we're going to record the fact that 6 of them were redeemed, 6 of the 10, or 60%. So we're going to say $1,200 of sales revenue will credit, and will debit or reduce our liability by $1,200 for the gift cards redeemed. Now, we need to book the cost of goods sold along with that, which would be 70% of $200. That's $140 times 6, which is the number of gift cards that were redeemed. And that comes out of our inventory, so we'll credit inventory for $840. You'll recall that these gift cards reduce inventory. Okay. Now in May, the remaining 4 gift cards are redeemed, and as you see, we will reduce the remainder of our unearned gift card revenue with a debit and credit sales revenue for $800 along with the cost of goods sold. And we have 4 of them at $200 times 70%, giving us a debit to cost of goods sold of $560 and a credit to inventory of $560. Okay, potential issues. One problem that complicates the accounting for gift cards is that you may never use the gift cards. This situation is sometimes referred to as breakage or forfeiture. For example, Starbucks recently recognized $60.5 million of breakage revenue. And so coming back to Haven, if Haven estimates that it's going to have 20% breakage, it's going to expect that 2 of its gift cards at $200 will not be redeemed. They also expect that $1,600 of the $2,000 will be redeemed. So Haven is going to recognize this breakage revenue of $400 as well as its gift card revenue in proportion to the customer's redemptions of those gift cards. Okay. Customer advances. Ethan Allen, furniture manufacturer, agrees to sell custom-made couches to Central Perk for all of its coffee shops. Ethan Allen requires Central Perk to provide a down payment of $300,000 before it designs and manufactures the couches to Central Perk specs. The total price for the couches is $2 million. The down payment is made on December 10th, 2025, and the couches are completed and delivered to Central Perk's locations on March 4th, 2026. Central Perk pays the remaining $1.7 million due on the couches on March 4th, 2026. All right. To record the receipt of the customer advances, we're going to debit cash. Of course, we've received the $300,000, but also we'll credit the liability unearned revenue dash customer advances. Ethan Allen's going to report that as a current liability related to this advance on its December 31, 2025 balance sheet. Then it's going to record the sale of its couches on March 4th, 2026. It gets the remaining $1.7 million in cash. It's going to zero out the unearned revenue dash and customer advances liability for $300,000, this same $300,000, and credit the full $2 million of sales revenue. Okay, let's put this all into practice. Presented below are selected transactions of Congo Corporation for the current month ended December 31st. 1. Congo publishes a magazine related to possible vacations in Africa and sells subscriptions to customers. In December, Congo sold and received $22,000 in subscriptions to customers. The magazine will be issued in February of the next year. Number 2, in December, they also sold 100 gift cards at $10 per gift card. 30 of the gift cards are redeemed by year end, and it estimates that 40 of the gift cards will not be redeemed. Breakage. Okay. And number 3, in December, Congo rented out a portion of its office space. It received a security deposit of $5,000, which will be returned at the end of next year. All right, so the journal entries. First, we're going to record the unearned subscription revenue. We received the cash, so we'll debit it for $22,000 and credit unearned subscription revenue for $22,000. To record the unearned gift card revenue, yes, we received the cash, $1,000, so we'll debit cash and credit unearned gift card revenue, the liability, for $1,000, $10 times 100 gift cards. Then to record the revenue on the gift cards that have been redeemed, will reduce the unearned gift card revenue by $300 and credit sales revenue for $300. Now, for the breakage, we will still reduce unearned gift card revenue with a debit of $200, but we'll recognize the sales revenue of $10 times 40 that we actually will expect to be redeemed, times the 50% that are not going to be redeemed. So this reflects the $200 of gift card breakage. And lastly, we're going to go record the liability for the refundable deposit. Yes, we received the $5,000, so we'll debit $5,000 cash and credit refundable debit liability for $5,000. Okay, now we'll take a look at explaining accounting for losses and gain contingencies. Contingencies are defined as an existing condition, situation, or set of circumstances involving uncertainty as to possible gain contingency, or possible loss contingency, to an enterprise that will ultimately be resolved when one or more future events occur or fail to occur. Loss contingencies involve, of course, possible loss. The likelihood of a loss can range from probable to reasonably possible to remote. So how we record that is going to be based on those 3 levels of likelihood of loss. Okay, so obligations related to product warranties and product defects are most probable that they're going to be accrued. So we're going to usually accrue that, and any premiums offered to customers, we're going to usually accrue that as well, that loss. What we're not going to normally accrue is losses due to the risk or of loss or damage of an enterprise property by fire, explosion, or other hazard. Yeah, that might happen, but that's a very remote possibility. We're not going to accrue for that. General or unspecified business risks, yes, they occur, but we're not going to accrue for that. Now, what may be accrued, if you're in an area where your assets may be expropriated and there's a good threat, then maybe we do accrue for that. Pending or threatened litigation, if it's probable, we're going to accrue for that. If it's possible or remote, we probably will not. But if it's possible, we will show that as a note to financial statements. And actual or possible claims or assessments, depending on its likelihood of being a loss, and guarantees of indebtedness of others, depending on, again, the situation, and then agreements to repurchase receivables or related properties that have been sold. Okay. Now, again, coming back to threatened litigation, these or any of these items, they should be accrued when both criteria exists. 1, it's probable, and 2, it's reasonably estimatable. Okay, and it has to meet both those criteria in order to be accrued. All right, let's take a look at an illustration. You're the accountant for Good Person Company. Your company believes that it has responsibility to help in its community and therefore is a big supporter of the Boys and Girls Club. Suppose that a few years ago, the Boys and Girls Club borrowed $3 million from Atlas Bank to build a gymnasium and improve the club's recreational activities. Good Person agreed to guarantee the borrowing, indicating that if the Boys and Girls Clubs defaulted on the loan, Good Person will pay the remainder of the debt due at the settlement date. Unfortunately, the club did default on the loan, and Good Person estimates that its contingent liability on the loan will be $1.8 million at settlement date. All right. We're going to record that because this is both probable and estimatable. So we'll debit loss on the loan guarantee and credit a guarantee liability of $1.8 million. In this case, a contingent liability is recorded in the accounts because it's probable that the future event, payment by Good Person, will occur, and the amount of the liability can be reasonably estimated. This means that the loss would be recorded with the debit and a liability established, the credit, in advance of the settlement. That looks like a good place for us to stop this video. And when we return, we'll take a look at an expropriation loss contingency. Until that time, bye for now.